Greg Daco is chief economist at EY-Parthenon. He joins us now. Greg, do you think the odds of a rate cut have increased?
I think the odds of a rate cut before the end of the year have increased, yes, because we are in an environment where we are seeing eroding economic activity, as Steve was correctly pointing out. An environment where you have prolonged tariffs leads to higher inflation, but also induces demand erosion, demand destruction. And I think over the course of the next few months, we're going to see an erosion of labor market fundamentals that will push some policymakers to favor a rate cut. We think the first rate cut will come in September, but I don't think we should necessarily completely plan out the month of July as a potential for a rate cut. We know there's a heavy split within the FOMC from the recent dot plot, with some anticipating no rate cuts this year and some anticipating 2 rate cuts this year.
Yeah, do you have any window into what you think is going to happen with trade and tariffs? Because there's a lot of ifs and maybes and buts.
I think it's important to remember that there are guardrails around trade policy. That's really the first thing to remember. We're unlikely to go back to the extremely high tariff rates that we had after Liberation Day. I think there's still the possibility that we will see a few days where there's uncertainty as to what the reciprocal trade policy will be and whether it's suspended for a longer period of time. But in general, I think we should grow accustomed to an environment where the average tariff rate is currently close to 15%, which is the highest since 1939. And that's likely to remain the case over the course of the summer and into year end, which means higher inflation coming due and less business investment, less consumer spending as a result of that.